Hello, very good morning to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here again, and I hope that you all have a great break as well as a restful weekend. And welcome to a brand new week ahead, a brand new quarter, because today is the 2nd of July, the start of a brand new month and a brand new quarter, which is Q3. So, very good morning. Welcome to today's Daily Dose of Market Insights. Today will be Tuesday, the 2nd of July, 2024. So before we start our usual daily dose of market insights in terms of the technicals and as well as the fundamentals, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product. Pardon me. Any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term intraday technical outlook on the major US dollar pair, the major stock indices, and two key commodities, that is, i.e. the gold XAU/USD and oil, WTI, West Texas crude oil, let's have a recap what has taken shape over the weekend and as well as yesterday. All right, so over the weekend, we do have this key risk event, which is the France parliamentary election over here. So let me quickly bring you guys to my screen so that you guys could see much clearer. Okay, I hope that the screen is being reflected. All right, good. Okay, so over at the first, okay, let's have a recap why this thing is important, because the France parliamentary election impact the euro dollar, which also impact the FX market, and in somehow or rather impact the European stock indices. So that's the reason why I want to highlight this event for you, because it's considered as a key macro event in a short term to medium term perspective. So what you see over the weekend over here is for France, they are actually a bit unique. They do have two rounds of parliamentary election, the first round followed by the second round. So the first round, as long as any key party did manage to gain the majority of the French parliamentary election, it will actually face off with the next two means the two best performing party in the first round will do a face-off. In the second round, that's going to be held on this coming Sunday at the 7th of July. So far, we in market expectation, Le Pen far right party, far right, wins the first round. All right. So, but however, she didn't get a majority. What do I mean by this? So if we go down to this Bloomberg News article all the way down on my screen, okay, this is the party. So overall, in order for the National Rally, which is Le Pen's far right party, to gain a significant foothold, that means absolute majority in the French parliament, she got to have 289 seats. Okay, so far, based on the latest counting, she roughly will get this projected vote share of 33% to 34.2%. So that translates to a projected seats of 230/305. That means it's not certain that she will get the 289 seats. All right. Then coming up next will be the New Popular Front. So this guy belongs to the far left, the socialists, coming in at 28%. Then Macron party is the worst at 20%. So right now, once the release of this particular projected vote share in yesterday's trading session the market got a hand of this, and also Macron's right now is doing some horse trading with this New Popular Front party over here, the far left, to actually deny Le Pen's party to get a majority share of this 289 seats. So what we could see over here is that there was actually a relief rally in the euro. The euro shot up 0.5%, followed by the French stock indices, the major stock index, the CAC 40, that also rose, I think, 2% as well on the intraday basis, and followed by the German DAX. But however, throughout the end of the European session, all these gains has been reduced. Okay, so later I'll touch on the fundamental intermarket analysis, why there is still this ongoing lingering risk of impact coming out from this potential, we call it Le Pen's National Right Party gaining a significant foothold on this coming Sunday when France starts to kickstart the second round of the parliamentary election. Okay, later I'll touch more about that. Now, US market performance yesterday has been rather robust within our expectation, where the Nasdaq 100 and the S&P, no, the Nasdaq 100 and the Dow Jones Industrial Average both rebounded from our short-term intraday pivotal support that we highlighted on Friday before I went for a break yesterday. And what we could see, as usual, the main outperformer is the mega cap stocks. All right, the mega cap stocks over here. Okay, so we see a sterling performance for Microsoft 2%, Apple 2.91%, Amazon 2.04%, as well as even Nvidia 0.61%. So the weaker performer come from the lesser weight market cap component stock, which is the industrial, energy, as well as real estate and some part of the consumer staples as well. Okay, so net, if you look at this is the 1-day performance of the heat map. So if I go to groups over here, you're able to see the breakdown of the performance of the key S&P sector. Okay, let me, I think my screen is frozen again. Okay, let me enlarge this so as you guys could see. Okay, let me close this. Okay, so what you could see is that technology was the top performer yesterday, the S&P sector plus 0.95%. Followed by consumer cyclical, then energy a little bit as well. Then what we could see over here is that the real estate and the industrial was the worst performer yesterday, down close to -1%. But net overall is still a rather positive session for the US stock market. Why? If you look at the current intraday performance on the S&P, it went down at a weaker start at the opening, but thereafter it did that minor bullish reversal throughout the intraday session, shaping that rather shallow V-shaped recovery and close higher at the end, with S&P 500 gaining 0.27% yesterday. The Nasdaq 100, I explained, was the top performer, driven by the mega cap technology stocks with the likes of Microsoft, Apple, Amazon, and Nvidia. V-shaped recovery as well. Weaker start at the start of the US session, but managed to shape a minor bullish reversal throughout the intraday session and close higher. Ended the US session as a top performer at 0.66%. So the Dow Jones Industrial Average was rather lackluster, but still managed to shape that much more shallower recovery, but still didn't actually close near the high of the day. All right, but still managed to actually inch out a slight gain of 0.13%. Okay, 0.13%. So the reason why was because Dow Jones Industrial Average, they do have certain industrial component stocks that was underperforming the market yesterday, which I flashed out to you earlier on based on this grouping. Okay, this S&P heat map, where the industrial sector is the worst performer yesterday. All right, so in terms of the indices, the worst hit was the Russell 2000, -0.86%. So why the Russell 2000 was worst hit yesterday was due to the rising US 10-year Treasury yield. So if you look at the US Treasury yield yesterday, it actually rose pretty significantly. Where was it? Yeah, this is the one. Yeah, this is the index. Okay, it rose pretty strongly yesterday, getting the positive follow through on last Friday. So very surprisingly, last Friday, right, we do have the release of the core PCE inflation data in US, which came in within expectation, 2.6% year on year for the core, 2 basis point lower than 2.8% year on year that was printed in the month of May. So the reason why this US 10-year Treasury pushed up higher, so if you were to look at the 1 month, okay, 1 month, sorry, 1 week. Okay, so this strong push up on that actually took shape on last Friday. So last week, a strong rebound on the US 10-year Treasury yield in terms of magnitude that was 14 basis point increase, is the highest since 1st of April, the week of 1st April, this long candle over here. So last Friday push up in the US 10-year Treasury yield is more driven by a long-term factor, not really much concentrated on the shorter term or medium term US economic factor, which is the core PCE data that came in within expectation. But the core PCE data that came in with expectation didn't actually cause the US 10-year Treasury yield to slide downwards. But market is now pretty much concerned about a potential Trump president era again going forward. If you recall that, last Friday I shared with you all that the betting odds of Trump is now getting a wider head start compared to Biden after that Trump's much more forceful and impactful first debate against Biden on last Friday. For those who managed to catch a replay of that, you guys should understand what I mean. So Trump himself is actually advocating much more higher tariffs towards China and potentially towards other adversary that he's deemed that is detrimental to US growth. Okay, and also he's also a favor of much more tax cut and much more both on the corporate side and as well the personal side. So higher tariffs, pushing for much more tariffs not on China but against other country as well. Higher tax cuts both on the corporate sides and as well as on the personal side of things, that could actually increase US budget deficit in terms of the tax cut. Higher tariffs could actually lead to tit for tat measures by other trading partners of the US. That means, i.e., potentially certain imported goods of the US will get more expensive. So that could actually lead to potentially higher imported inflation, which doesn't, which also means that inflationary pressure in US in the long run may not start to actually go down lower. That could be potentially lead to what I call a uptick in US inflation if Trump were to propose his initiative as he advocated at this point in time. So that actually explained to us why the US 10-year Treasury tick up significantly last week, going against the softer inflationary trend that is seen right now in the core US PCE data that was released on Friday. And bear in mind, core PCE data released on Friday, that was for the month of June. Whereas Trump policy will impact the US inflationary trend going forward from a multi-year perspective. And the 10-year US Treasury yield track two things. It track US longer-term inflationary trend and US growth as well. Okay, so one of the reasons why it ticked up on last Friday and it's going to push up on Monday was due to that risk of higher inflationary pressure creeping into the US economy in the longer term if Trump were to actually establish or push through his current advocation of higher US tariff against China and against some part of the world, lower tax cuts on corporates as well as individual. All this will actually drive up indirectly or directly on the US budget deficits. Eventually, inflation conduit will start to face a upside pressure. Okay, so that should explain the push up in the US 10-year Treasury yield, and also the push up in the US 10-year Treasury yield managed to saw the US dollar gaining strength as well. Okay, so what we could see over here is that initially the US dollar saw a sell-off during the start of the session yesterday, the Asia session sell-off due to that positive result out from the French election, where based on the current numbers, the voting numbers, Le Pen hasn't got a major so-called major majority yet in the France parliament, but that news has been offsetted because it's still rather cloudy. Later I'll show you why intermarket relation, why there's still elevated credit risk in the French economy, and that causes the dollar to push up as well. And also another factor that's supporting the push up in the dollar yesterday that managed to form this long-legged candlestick pattern was due to the fact of the higher 10-year US Treasury yield that has a positive follow-through during Asia session, during yesterday's Asia session throughout the US session as well. And overall, what we could see over here is that it's still, the dollar is still continues to be trapped within a very short-term range scenario between 106.37, that's the top of the range, which is the swing high area of 16th of April and 1st of May, and as well as this descending trendline resistance that I drew from the high of 4th of October last year. And in the near term, it's being supported by the 20-day and the 50-day moving average, as well as this recent minor swing low that is all coming to act as a near-term support at 105.24. So going forward, the dollar in the very short term could be trapped between 106.37 and 105.24. But in the longer term, if the US 10-year Treasury yield continue to inch much higher going for in the long term, that means we're talking about multi-month perspective, given Trump's potentially number one, Trump's got to win the U.S. president election first. Then thereafter, market will have a close watch whether will he push through his initiative, which I explained to you all earlier on. If does that go through, that could be lead to a U.S. China against the rest of the world, or U.S. China / U.S. adversary trade war 2.0, lower tax cut, higher tax cut, that could be rather inflationary in nature in a long-term perspective that could drive up US 10-year Treasury yield, and that could also potentially see a favor of a longer-term dollar strength going forward. But that's more for a long-term perspective. But from a short-term perspective, that means based on for our daily dose of market insights, we are now looking at these two levels first. So it seems to us that on yesterday's push up on the US dollar on this particular long-legged candlestick, there could be some form of short-term minor strength on the dollar to retest the 106.37 level again from a shorter term perspective. Okay, given yesterday's bullish reversal candlestick. All right, this we call it dragonfly, daily dragonfly bullish reversal candlestick. Okay, so now with that, this is the intermarket perspective. Another intermarket perspective that's more related also to the dollar as well, because it could actually impact the euro dollar. So let us take a look at the France credit risk that is inherent in the France economy in this up and coming second round of France legislative election. That's Le Pen's party got to face off with either a coalition between the far left and Macron's centralist party, given that they need to pair up as the second ranking party to prevent Le Pen from getting a majority vote in the France parliamentary election. So if you look at how do we see credit risk in the France economy, is by looking at the credit spread between the 10 years France sovereign bond against the 10-year German sovereign bond. This is the spread between this 10-year. So what we see that on the onset, before that, this spread starts to actually widen over here. So if you look at from on the daily perspective, right, this is the daily chart over here. Okay, so given the fact that yesterday it starts to actually inch down from a high of 0.82% that was printed on last Thursday and inch downwards, and yesterday inch down is still rather at an elevated level. So at 0.45% now is still higher than last Tuesday low of 0.1%. So at this level it's still close to a high that was last seen, all right, in 29th of March 2013. Okay, so that was close to that. That's almost a so-called put in a way that is close to around a 11 year high. all right, close to 11-year higher, that is still rather elevated at this juncture. So what we could see over here is that yesterday's result didn't actually see a reduction in the France credit risk. All right. So if there's no reduction in the in this credit risk in the French economy, that is still rather elevated. Why? Because if markets will view in a way that if Le Pen's party were to get a significant foothold, or worse still, because of this horse trading that's going on between Macron's centralist party and the far left party. That means Macron's centralist party will get a dilution of power. Some parts of its power will got shared with the far left in order to prevent Le Pen's far right party to getting a significant foothold. That means, i.e., the far left party right now will have a stronger say going forward in the France parliamentary legislation. And don't forget, the far left, the socialists, they have much more advocate of spendthrift spending policy. That means further much more expansionary fiscal policy than the far right. Now, the far right really advocate for more spending in the French economy. And given that the far left now, the socialists now will have a significant say, given that Macron's party now is ranking the third rather than the second, that means, i.e., the far left will also have a much more say right now going forward in crafting the domestic economic policy of France. And given these two parties, both the far right and the far left are advocating much more expansionary policy in the French economy. The far left, the socialists, is more forceful on that. The net result is higher chance that the French economy budget deficit will widen. So if a widen in budget deficit, that could translate to elevated credit risk on the French economy. So that is being explained by this ongoing, still high elevated yield spread between the 10-year France government bond against the 10-year German government bond. And how does it relate to the stock market? If you look at the stock market yesterday, the CAC 40, which is the French benchmark indices, the benchmark of a stock index for the France stock market, didn't actually perform that well. Yeah, even though it closed positive at 1.09% yesterday, look at the long black Marubozu candlestick that it formed. Okay, so initial gain, it gap up, then thereafter the gain almost all reversed throughout the European session, and it closed lower as well. Okay, didn't cover the gap, so that's why it explained to us it's still gaining 1.09%. But where it reacted, right, the way it reacted, it failed to break above the 20-day moving average that is acting as a resistance, and as well as the the last minor swing high of 24th of June, 26th of June, and again rejected yesterday. And this rejected form a rather significant bearish reaction by this black Marubozu candlestick. Okay, so it rejected of key technical elements, downward sloping 20-day moving average and the current last lower high area. This is the lower, this high, and this high is lower, this last lower high or lower swing high at the 7,706 level. And given that this bearish reaction yesterday towards the later part of the European trading session also have a negative feedback loop into the German DAX. So the German DAX also ended lower at, yes, positive 0.3%, but if you look at the candlestick, it formed a bearish reversal shooting star. All right, right exactly also at a key resistance level, which is this former minor swing low here at 18,400 thereabout, and failed to break above the 50-day and close right below the 20-day despite a intraday push up. But at the end of the day, it can't survive the initial bullish momentum. So net overall, that increased credit risk, that why can't it increase, that still high elevated credit risk in the French economy, as shown earlier by this credit spread between the US, the 10-year, that 10-year France government bond yield against the 10-year yield of the German bond. translate to a negative feedback loop into the German stock market, and most importantly the France stock market as well, that lead to the euro dollar that being what I call that the euro dollar strength being diluted yesterday after the US session open. All right, so what you could see over here, this is the 5-day rolling performance of the US dollar against other major currency. Initially, the dollar sold off at the start of yesterday, at the start of the Asia session. Then right after the middle part of throughout the second half of the European session, and also throughout the US session started, the euro dollar starts to lose strength, where the dollar starts to see a pickup against the euro, and that also translate to dollar strength picking up against the other major pair as well, especially against the dollar yen, the dollar CAD, the dollar Swiss, and the dollar Japanese yen, the dollar Kiwi, pardon me, the dollar Swiss, and the third ranking will be the dollar CAD, followed by the dollar sterling. Okay, so so net overall, we do see a recovery of dollar strength on the intraday basis yesterday after the after the what I call it, the initial bullish momentum of the European stock indices that could not maintain during the second half of the European session, where it led to the formation of bearish reaction candlestick that I explained to that I show you all in the CAC 40 and as well as the German DAX. Why? Because of elevated credit risk in the French economy, as being shown by the spread between the 10-year France government bond yield against the 10-year German bond yield. Then that translates into that dollar strength coming forward in the later part of the European session, heading throughout the US session, when the also another factor is being supported by the push up in the US 10-year Treasury yield to test that 4.5% resistance again, due to a potential potential Trump president win going forward, given the fact that Trump performed much better during the first presidential debate against Biden on last Friday. All right, so this is the current key intermarket, we call it intermarket dynamics relationship that I want to share with you all. Okay, more on the FX market perspective. Now, with that, let us now jump straight into the short-term technical outlook on the 4 major dollar pair. But before that, let me expand my screen so that you guys could have a better picture. All right, so now let us start with the give me a minute. I think you guys could still see me. Okay, good, I'm off. So now let us start with the euro dollar. Okay, still recall the euro dollar before I went for my break. Yes, okay, why is it not showing up? Okay, euro dollar. Okay, so still recall that before I went for my break on Monday, we do have a bullish bias on the euro dollar, looking for it to test the 1.770, 1.0790 resistance level. So that level was already tested. And why this level is important, because it's like a magnet. It's the 20-day, the 50-day, and the 200-day moving average. And if you do the Fibo retracement from the last, we call it the last push down from 4th of June all the way down to the recent minor swing low of 26th of June, that actually confluenced with the 50% Fibo retracement. And upon hitting this resistance level yesterday, we do see a bearish reaction of this level 1.0770, if you could to look at the daily chart over here. Okay, we see a spinning top that's being formed. Okay, a bearish reversal candle. Okay, which is one bearish element. And if you go down to the hourly chart again, we could see now the hourly RSI breaking below a parallel support level. We tested it yesterday and inched down lower to form a lower high. All right, lower high. So this indicates to us that bearish momentum has started to creep back into the euro dollar pair. Okay, so this gives me the justification, or at least in terms of a technical analysis perspective from a short-term intraday basis, see this hourly chart, that there are much more bearish element clouding over potential bullish element. So with that, we will flip to a intraday bearish bias for today, for sure using 1.0770, 1.0790 as the key short-term pivotal resistance. Near-term support level to watch will be yesterday's low at 1.0720. A breakdown below 1.0720 may expose the 1.0666 level slash 1.0656 level, which is the lower boundary of this potential symmetrical range support, a triangle range support, as seen from this ascending trend gray trend line over here that I drew from the low of 3rd of October last year, that is coming to act as the support as this zone, okay, of 1.0666 slash 1.0656. Okay, however, only an hourly close back above 1.0790 will invalidate today's intraday bearish bias to see the euro dollar further extending this ongoing corrective rebound to test the next near-term resistance at 1.0815. Above it sees the minor swing high of 12th of June at 1.0850. Okay, so that's for the euro dollar. Then what we could recall over here is the British pound, the sterling pound. So the sterling pound, last Friday, we also see it test this resistance level. So last Friday, we have that bullish bias uh, being reflected, and the resistance was being tested at 1.27 figure level, which is also the 20-day moving average acting as a resistance as well. And what we could see over here is that the sterling dollar also did a bearish breakdown below this former ascending trendline support, and now trading lower high right below the 50 level mark on the hourly RSI, indicating to us that there is some form of short-term bearish momentum creeping into the sterling dollar. So with that, for sure, because of this bearish reaction right at the 27 figure level, so this is like a magnetic thing, hit bearish reaction. Okay, so first resistance to watch for today will be at 12663, this level here, 1.2663, but I wanted to use this as a pivotal resistance because not enough substantial element to justify this as a magnetic level. So I'd rather use 1.26 level to be much more cautious, because this level was being tested one time, tested second time, refusing to break, and also the 20-day moving average that is acting as a resistance as well. So as long as it didn't break above 1.27 figure level for today on the sterling dollar, so that will be my short-term pivotal resistance, I will flip to a bearish bias as well on the sterling dollar. First support level to watch will be close to last Thursday minor swing low at 1.2610 level. Okay, so this 1.2610 level also confluence with the former minor swing low of 3rd of May over here. We could see, okay, this 3rd of May, former minor swing low, swing high, pardon me, former minor swing high turns into a pullback support level as well, that confluencing with last Thursday low that managed to see our earlier bounce, which is really hit the resistance level at 127 figure. A breakdown below 1.2610 will expose the next near-term support level at 1.2565, which is this minor congestion area of 7th of May and 13th of May formally, and also the 200-day moving average that also conferencing at 1.2565. All right, only an hourly close above 1.27 figure level will invalidate today's intraday bearish bias on the sterling pound to see it to stage a further corrective bounce to expose the next near-term resistance at 1.2740, followed by 1.28 figure level. Okay, so that's for the sterling pound. Now moving on, next will be the Asia Pacific dollar major currency, starting with the starting with the dollar yen first. Let me start with the dollar yen. So dollar yen last Friday, we do have a bearish bias at this 1610 short-term pivotal resistance that we highlighted, but we do have a downside trigger level at the 160.30 on last Friday. So this level was tested again on last Friday, can't break below it, and it managed to break above 16110 during yesterday's US session. So with that, right, we got to respect the ongoing bullish momentum that's being seen on the dollar yen, where we start to see the dollar yen right now is oscillating well within this defined short-term minor ascending channel that I drew from the 13th of June. And yesterday price action clearly broke above the upper boundary of this dotted gray line, which is the upper boundary major ascending channel from the low of January 2023. So if you look at the daily chart itself on the dollar yen, okay, it broke above this line, okay, this ascending channel, okay, from January 2023. So very clearly, this dollar yen continues to bullish accelerate on the upside. And since that it broken above 6110 short-term pivotal resistance, so the next level to watch should be 6240, then thereafter 6360, 6560 level. Over here, we got to respect this bullish momentum. Okay, so with that, on the hourly basis for today, that means today's intraday basis, we will flip to a bullish bias using 160.80 as my short-term pivotal support level. That means, i.e., any potential pullback that managed to hold above 160.80, which correspond to the former minor swing high of 27th of June, and as well as the lower boundary of this minor ascending channel of 12th of June and the pullback of this former upper boundary of the major ascending channel from January 2023. All right, so it's an intersection point. So as long as 160.80 short-term pivotal support holds in any potential pullback for today, we will still maintain that we will flip to a short-term intraday bullish bias on the dollar yen. First resistance to watch 161.80, above it exposes 162.40. All right, only an hourly close below 160.80 will negate this short-term intraday bullish tone to see it floating back down towards 160.30, a breakdown below it. This is where we may start to see a much more deeper minor corrective pullback towards 159.90, then thereafter followed by 159.10 level. Okay, so that's for the dollar yen. Aussie dollar. So for the Aussie dollar, very interesting over here is that what we could see is that on last Friday, it managed to shape that push up as well, hitting that 166.70 level that we highlighted on last Friday. Then during the US session, it managed to sell off, and this sell off is now coming back towards the 20-day moving average and the 50-day moving average that is acting as a support at 66.40, 66.20. So with that, I will use 66.20, which was the V-shaped reversal that was formed during last Friday European session over here as my short-term pivotal support level. So as long as 620 short-term pivotal support holds over here, I will still maintain that short-term bullish bias within a range scenario. So the top of the range will be at 66.80 again. That was actually rejected on on Friday and as well as on last Friday and as well as during the start of the US session. Okay, it tried to break above the 6680 but got rejected. So this will be the upper limit of today's range, right? So it's something like a bullish bias within a minor range scenario. Okay, only a break above 6680 will expose the medium term resistance zone of 6710 and 6730. So what's this 6710 and 6730 is on the daily time frame, is the upper limit of this symmetrical triangle that I drew from the high of 3rd of Jan 2023. So overall, since the low of 13th of October last year and 3rd of February last year, the Aussie dollar is still trapped within this medium-term symmetrical triangle range configuration. All right, so back to the Aussie dollar. So unless we see an hourly close today below 66.20, then it will invalidate today's intraday bullish bias to see it floating down towards the bottom of that symmetrical triangle range configuration. But in first step, the near-term support level to watch will be at 65.90/65.80, which is the minor swing low of 17th of June and 10th of June. A breakdown below it exposes 65.50, which is also confluencing with the 20-day, 200-day moving average as well. All right, so that's for the Aussie dollar. Okay, so with that, that sum up the short-term intraday technical outlook for the major dollar pair. So now let us now jump straight to the major stock indices, starting with the Asia Pacific indices first on the Nikkei 225. So on the Nikkei 225, still recall on last Friday, we used the 39,230 as my short-term pivotal support level to maintain that short-term intraday bullish bias. Still no change. Price action managed to hit the resistance at 39,880 on yesterday's, okay, sorry, on Friday, and retested it again on today's Asia session before the start of our daily dose at 39,880. So still no change. This is the first resistance level equal to surpass. All right. So since this level is not taken out very clearly on the upside, I do not want to tight my short-term pivotal support to too tight to at 39,440. So that was the first support that I highlighted on Friday as well, that managed to survive on yesterday's US session. All right, so still no change. Still using 39,230 as my short-term pivotal support level, given that there's no clear breakout of 39,880. All right, so 39,230 short-term pivotal support, still maintain that short-term bullish intraday outlook on the Japan 225, i.e. Nikkei 225. First resistance to watch 39,880, a breakout above it exposes the next near-term resistance at 40,230. So what's 40,230 is the congestion area of 26th of March and 4th of April this year, and as well close to the upper limit of this ascending channel, okay, that I drew from the low of 19th of April. All right. Only an hourly close below 39,230 will invalidate today's intraday bullish bias to see it floating down to retest the rising 200-day moving average and the rising 50-day moving average, acting as a support at 38,740, followed by 38,460. So that's for the Japan 225. Now moving on will be the Hong Kong 33 and the Hang Seng Index, we call it. So on Friday on the Hang Seng Index, we flipped to a bullish bias. Why? Because of that bullish divergence that was seen on Friday morning itself at 17,600 level. So still no change, 17,600 as a short-term pivotal support level. So this level was almost retested again on today's Asia session before shaping that strong bounce up. So hitting the first resistance at 17,940 before shaping that pullback. Right, since this first resistance is not being surpassed clearly on the upside, so we're still using 17,600 as my short-term pivotal support level on the Hong Kong 33, i.e. the Hang Seng Index, still maintain that short-term intraday bullish bias on the Hong Kong 33. A break above 17,940 exposes the next near-term resistance at 18,180, which also confluence with the 50-day moving average, acting as a resistance as well. Okay, so that's the next resistance level to watch, 18,180. However, if you have an hourly close below 17,600, then this corrective, multi-week corrective decline scenario will resume to expose the next near-term support at 17,460. Below it exposes the key 200-day moving average at 17,170, pardon me, 17,170. We also confluencing with the former minor swing high of 13th of March. Is at 17,170. Right, so that's for the Hong Kong 33. Moving on will be the European stock index, will be the German 30 or the Germany DAX, we call it. So the Germany DAX over here is that even though it broke out from our short-term pivotal resistance we highlighted on last Friday at around the 18,000, this level here. Let me highlight again in red. Okay, so this was the pivotal resistance that we have for the entire of last week. So Monday it broke out, then bullish initial cannot maintain and reintegrate back below 18,370. And this level break where it met what it almost came to the second resistance that we highlighted after 18,370, which is the 18,520 level, okay, which is also close to the upper limit of this not upper limit, the descending trend line that I drew from the high of 16th of May. And if we were, this is the current all-time high, still made that this descending trend line got rejected one time, rejected twice, and now this 18,520 also coming is you've got to be at as the resistance of this descending trend line as well. And we were to do the Fibo retracement from the decline that takes shape from the current all-time high all the way down to the low of 14th of June. Okay, let me do it for it. Okay, so it also confluence closely to the golden ratio of 61.8 as well. Okay, just to make sure that, yeah, it's at the all-time high. Yeah, the golden ratio of 60.8 at 18,555. Okay, which is close to 18,520. So with that, right, I will still say that yesterday's push up could be a failure breakout. I mean, there's no momentum and should reintegrate back below it. And right now, if you were to look at the current RSI at this juncture, and if you could draw a ascending trend line, okay, it's now looking to break. Okay, it seems to me looking to break below this ascending trend line support, given yesterday's lower high, a series lower high, also breaking below the 50 level mark. So indicating to us that the upside momentum is not fantastic yesterday as well. So with that, I will still maintain a short-term intraday bearish bias for today on the German 30 or the German DAX, using 18,520 as my short-term pivotal resistance. But however, first support level to watch will be last Friday's low at 18,220. Only a breakdown below this last Friday low will give us much more impetus for the bearish force to gain much more momentum to retest the minor swing low area that is still in place since 21st of June, that was being tested 2 times, or I would say 3 times, at 18,085, I think, as a support level, next near-term support level. Okay, 18,085. Only an hourly close above 18,520 will invalidate today's intraday bullish bias to see a further squeeze up towards the next near-term resistance zone at 18,640, 18,685. Right, so that's for the German DAX. Now, moving on will be the major US stock indices, starting with the Dow Jones Industrial Average, i.e. the US Wall Street 30. So still no change for sure on last Friday and even yesterday's US session. It managed to help above the 39,090 slash 38,945 short-term pivotal support that we have level. We also confluencing with the rising 50-day and the 20-day moving average as well. So no change. This is indeed a key support level where it managed to bounce twice on last Wednesday, last Friday, and yesterday. So using this as a short-term pivotal support level, 39,090, 38,945, still maintain that short-term intraday bullish bias. First resistance to watch will be at 39,600. That is the swing high area since 24th of June. That is capping for the upside. Only above this 39,600 will expose the next near-term resistance at 39,790, which is the former minor swing low of 21st of May. However, if we start to see a breakdown below 39,000, 38,945, then this short-term intraday bullish bias will be invalidated to see a massive corrective push down to retest 38,720. A breakdown below it exposes 38,560, 38,420, which confluence with also with this minor ascending trend line that I drew from 30th of May. Okay, so that's for the US Wall Street 30. Moving on will be the Nasdaq 100. So the Nasdaq 100 continues to trade well above the Titan 9,645 short-term pivotal support level. So that level was being tested on Thursday, managed to bounce, hit the first resistance level that we highlighted on Friday as well during the Asia session, 19,990. Then thereafter it retraced. Yesterday, it attempts to sell off, but the sell off managed to help right again at the 19,645. And right now, the rising 20-day moving average is coming close to as this support level as well, very closely. All right, so for sure, this 19,645 is indeed a very key short-term pivotal support level to maintain the bullish bias. So with that, still maintain that short-term bullish bias on the US Nasdaq 100 using 19,645 as the short-term pivotal support level for today. First resistance for sure will be at the 19,990. That price action can't break on last Friday. Only a breakout above an hourly close above 19,990 may expose the next near-term resistance zone at 20,120 slash 20,120, pardon me, 20,155. Okay, which is defined by the Fibo extension level. Only hourly close below 19,645 will jeopardize this short-term bullish bias, intraday bullish bias, to see the start of a deeper minor corrective pullback to expose the next near-term support level at 19,480. Below it sees 19,240 next. Okay, so that's for the US Nasdaq 100. So overall, I would say that majority of the major stock indices still remains above their short-term respective support, key short-term pivotal key respective short-term pivotal levels, support levels, pardon me. Only the German DAX still showing some form of intraday technical weakness, all right, below a key short-term pivotal resistance at 18,520. So that's for the German DAX. Now, with that, let us move on to the commodities market, starting with gold first, XAU/USD. So gold last Friday managed to see a push up above the 2003-18 short-term pivotal support resistance level that we have on last Friday. Then thereafter, it managed to hit the next resistance very closely at 2,344. We also close to the 50-day moving average as well. That is acting as a resistance. You will see this dark blue line here, and tested both on Friday and even on Monday. Can't break above this level. And this 2,344 is also confluencing with this minor descending channel that is still in play for the gold XAU/USD that I drew from the current all-time high of 20th of May. Okay, so it's still within this descending channel. So given that element is rather mixed, why? Because price action still can't break above 2,344, which is also the descending channel resistance. And yes, on Friday we see a bit of recovery above 2,318, but this recovery at 2,318, thereafter it starts to produce a series of lower high, this high lower than this high. At the moment, the Asia session, this high lower than this high. So this forms a bearish divergence on the hourly RSI. So indicating to us that despite this positive move in seen on last Friday, but it doesn't accompanied by a rather healthy bullish momentum as depicted by the hourly divergence that's being flashed out, condition that's being flashed out on the hourly RSI. So with that, I will have a rather neutrality stance instead, since it can't break above 2,344. So neutral between 2,344 and 2,318. So 2,318 is a very clearly this minor range bottom that has started to form since last Friday. Okay, last Friday. However, it starts to see an hourly close below 2,318, then potentially we could revisit the 2,300 psychological level again, which is close to the minor swing low of last Wednesday. And a breakdown below it exposes the next support zone of 2,280/2,270 to resume this minor multi-week corrective pullback sequence that is still trading within this descending channel that I drew from the high of 20th of May, because the bottom of the descending channel still has more way to go at around the 2,240 level, 2,210 level. Okay, but we are taking things one step at a time. So flipping to a neutrality stance for today, given the lackluster movement on gold on the hourly RSI, despite of last Friday positive push up, neutral between 2,344 and 2,318. So that's for gold. Lastly will be the West Texas crude oil. So West Texas crude oil continues to shape that bullish momentum. All right, a very strong push up above the 20-day moving average and the 50-day moving average. So the next medium-term resistance will be at the swing high area of 5th of April and 11th of April at 87.85. All right, so on the shorter term basis, this is a daily chart. So on the shorter term basis, still recall last Friday, we flipped to a bullish bias above 80.70, now almost hitting the resistance at 84.40 level. So with that, we'll still maintain that short-term bullish momentum. Yes, the hourly RSI is hitting the overbought level already at the overbought level, but there's no clear signs of a bullish divergence, bearish divergence. Why? Because price action continues to shape a higher high over here, in line with the price action of the raw price action on West Texas oil. So yes, RSI overbought, so indicating there will be a chance of a pullback. So as long as this pullback today managed to hold above the Titan key short-term pivotal support level that I have at 81.90 level, which also confluence with the lower limit of this minor ascending channel that is in play since the low of 4th of June, we'll still maintain that short-term bullish bias on West Texas oil. Next resistance to watch after 84.40 will be at 85.05. So what's 85.05? 85.05, if you go back in time, it will be the congestion area here of 15th of April, corresponding to the minor swing high of 26th of April. All right. However, only an hourly close below 81.90 will invalidate today's intraday bullish bias on West Texas oil to see a deeper minor corrective pullback to retest last week low at 80.60. A break below it exposes the 50-day, the 200-day, and the 20-day, all acting as a support zone at 79.45/78.90 if 80.60 can't hold at the support level. All right, so with that, that sum up today's intraday technical outlook on the key cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key events to look out for today? So for today, we do have the European zone aggregate flash inflation rate for the month of June. So for the core inflation rate, market is still expecting a lower deflation inflationary trend to take shape in the Eurozone, coming in at 1 basis point lower at 2.8% from the previous 2.9% that was printed in May. Right, so that's something to look out for at 5 p.m. Singapore time. Then thereafter, during the US session at 9:30 p.m., we have ECB Lagarde speaking, and as well as Fed Chair Powell speaking as well. All right, so both key monetary policy officials speaking at 9:30 p.m. on the Euro side of the thing, Eurozone, that is ECB President Lagarde, and from the US side of the story, we have that boss Fed Chair Powell speaking at the same time. Then thereafter will be a rather quiet US session in terms of economic data release. All right, so that's sum up for today's daily dose of market insights. So with that, I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.